Is inflation bad for stocks? With the Treasury printing money left and right and the possibility of rising prices looming over the economy, price-to-earnings ratios could also be in trouble. So says Reuters columnist Rolfe Winkler, and he joins me now. So why is inflation bad for stocks? I mean, isn't it good for them? These companies can pass along extra costs to consumers and their profits go up.
Well, that, right there, it depends. The hit to earnings could be positive depending on whether inflation, the relative impact to revenues and to costs. It's possible that my costs increase faster than my revenues and therefore my earnings would decline. The bigger issue with stock valuations and inflation is, look, a stock is, it's worth, what's the fancy definition is, a stock is worth its discounted future cash flows.
What I'm willing to pay for
I'm willing to pay for a stream of earnings in the future. And historically, the historical multiple on the S&P is 17. So if I have a company with $1 of earnings today, then I'm willing to pay 17 times. I'm willing to buy that stock for $17. It would effectively, with no growth, take 17 years to pay me back. Now the issue is, in an inflationary economy, my future earnings are worth less to me, right? $1 of earnings 10 years from now is going to have much less purchasing power if I have high inflation, and therefore that earnings stream is worth a lot less. I'm going to apply a lower multiple to it, and so multiples compress. And in fact, if you look at the historical data, sure enough, when inflation is low and stable, you have higher PE ratios in the 60s and in the 80s, 80s up until a recent period. But in the 70s, when inflation was high, PE ratios came down significantly.
That said, I mean, don't you need to be invested in equities at some point? And isn't this being invested in equities also one of the best hedges against inflation if we have rising asset values?
Well, I think that's the danger, right? Is that if you have higher inflation, there's no real good place to hide. There's no good place to protect paper wealth, right? And that's why you see a lot of people crowding into the gold trade now, which is itself a little dangerous because you may have a lot of herding going on. It's now a pretty popular trade, but that's why, for instance, you get something like gold, which is very popular, which did very well in the 70s. And if inflation fears pan out today, it could continue to do well.
What about deflation? Because it's interesting, what we're hearing from the Fed is more about the risk of asset prices and prices staying in this level. How does that affect PE multiples? I can't tell you for sure because we haven't had a deflationary episode, a very strong deflationary episode, since the 30s. And back then, PE ratios, it was actually quite variable, inflation to deflation back to inflation. So the PE multiples, it was a roller coaster. That said, I'm forgetting your question all of a sudden. Where was I going with that? I think it's good to forget the question because hopefully everyone will forget it and we won't actually go into a deflationary environment because
think that anyone can to your point, yeah, of course, that the Fed says, look, deflation's the threat because we're still delevering. And that's actually very true. The bigger risk is, well, what if the monetary and fiscal countermeasures turn out to be too much?
Right, and juice us all the way up to inflation, and then we'll be we'll be reading your column and trying to figure out if indeed we see these PE ratios compressed. Rolfe, thank you very much for coming and walking us through this. We appreciate your time. Rolfe Winkler, Reuters columnist. This is Reuters.